Hey there, savvy investors, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze plays. Today, we're putting a specific company under the microscope, TGHL, or the Grower Hub Limited. We've got some incredibly interesting data points on this stock, and we're going to break down exactly why it's caught our attention. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. TGHL logo/stock chart. Let's zoom in on the Grower Hub Limited, trading under the ticker TGHL. This company operates in the technology and software infrastructure sector, providing crucial product traceability, data analytics, and product trading facilitation solutions, primarily in Singapore and internationally. With a market cap currently sitting around $20.06 million, it's definitely in the small cap category. Looking at recent price action, TGHL has seen some significant movement today alone. It's up an impressive plus 23.30%. Over the last 5 trading days, the stock has gained plus 41.25%, though it's still down minus 9.34% over the past 30 days. Volume has been absolutely massive, with today's volume hitting 107,512,400 shares. That's a staggering 20.9 times its 30-day average volume of 5,153,276 shares. What is cost to borrow and why it matters? So, why exactly does hard to borrow mean, and why should it matter to you? When a stock is hard to borrow, it refers to shares that are difficult for short sellers to obtain from their brokers. To short a stock, you first need to borrow shares, sell them, hoping the price will drop, and then buy them back at a lower price to return them to the lender, profiting from the difference. For this service, short sellers pay a fee known as the cost to borrow, or CTB. Think of it like an interest rate you pay on money you borrow. When a stock is in high demand for shorting, or when there are very few shares available to lend, the CTB fee skyrockets. And yes, these annualized fees can easily exceed 100%, even reaching into the hundreds or even thousands of %, making it extremely expensive for short sellers to maintain their positions. Why the stock is hard to borrow right now. Shows CTB chart for TGHL. Now let's talk about why the Grower Hub Limited TGHL has popped up on our hard to borrow screener with such urgency. The cost to borrow fee for TGHL is currently at an astonishing 768.8% annualized. That's not a typo, nearly 770% just to hold a short position for a year. What's more, the CTB has seen incredible momentum, surging by plus 328 percentage points over just the last 5 trading days. This indicates a rapid increase in demand to short the stock, coupled with a severely shrinking supply of available shares. Speaking of supply, as of our latest data, there are only a meager 80 shares currently available to borrow for TGHL. With an estimated float of 12.7 million shares, having only 80 shares available to borrow is practically nothing. This combination of an astronomical cost to borrow, aggressive CTB momentum, and an almost non-existent supply of borrowable shares is precisely why TGHL stands out. Highlight 768.8% CTB. Squeeze mechanics explained. So, what does all this mean in the context of a short squeeze? When short sellers borrow shares and sell them, they create a synthetic supply of shares in the market. But they still have an obligation to buy those shares back eventually. If the stock price starts to rise, fueled by positive news, strong buying volume like we're seeing today, or simply a lack of available sellers, short sellers begin to feel the pressure. Their losses accumulate rapidly, and the high cost to borrow only exacerbates the pain. To stop the bleeding, short sellers are forced to cover their positions, which means they must buy back shares from the open market. This sudden demand for shares, often from panicked short sellers, pushes the price even higher, creating a feedback loop. This snowball effect, where buying begets more buying due to short covering, is what we call a short squeeze. Dilution risk check. An important factor in any short squeeze thesis is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can flood the market with new supply, offsetting or even negating any upward price pressure from short covering, even when the cost of borrow is sky high. We've checked for recent diluted SEC filings for TGHL, specifically SMINUS1, SMINUS3, or 424B forms, in the last 90 days. We found no recent diluted filings for the Grower Hub Limited in that period. This is a positive sign, as it suggests the company isn't currently looking to inject a large amount of new shares into the market, which could otherwise dampen a potential squeeze. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Our internal composite squeeze score for TGHL, which combines factors like CTB level, momentum, borrow supply, float size, and technical setup, currently stands at a robust 74.5 out of 100. This is a significant score, indicating a compelling setup. The massive relative volume today, at nearly 21 times its average, combined with the stock's plus 23.30% gain today and plus 41.25% over 5 days, shows strong buying interest and potential upward momentum. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have strong conviction in the bearish thesis and are willing to pay a premium to stay short. It's about monitoring the catalysts, the price action, and especially the continued availability of shares to borrow. A sustained rise in price and a continued tightening of borrowable shares would be key indicators. Show TGHL 5-day chart. The situation with the Grow Hub Limited TGHL presents a very interesting case study in how to borrow dynamics. With an annualized cost to borrow nearing 770%, a virtually non-existent supply of borrowable shares, and strong recent buying volume, it's definitely a stock to watch closely. Remember to do your own thorough due diligence. If you found this breakdown helpful, please smash that like button, subscribe for more in-depth analysis of hard-to-borrow stocks, and let us know in the comments if you have any questions or other tickers you'd like us to cover. Thanks for watching, and we'll see you in the next video.